Rome did not build its empire on courage alone, it built it on debt. We always imagine Roman legions as honorable, disciplined, and unstoppable warriors. But behind every shining helmet and sharpened gladius, there was an incredibly complex and expensive supply chain. Thousands of soldiers needed food, weapons, equipment, and pay. Just like the soldiers, their horses also had to be fed. Siege machines required processed timber and significant manpower, and all of this was only possible with a great deal of money. A lot of money. So how did Rome finance these long wars? And is this still relevant today? Because the deeper you look into Rome's war machine, the clearer the pattern becomes. War was not fought only on the battlefield. Money was embedded into the system, and once that system was set in motion, it could not stop. Expansion was not a choice. It was almost a necessity. Does this sound familiar? Let's go back. In the early Republic, Rome's army was a citizen army, made up of its own people. If you owned land, you were very likely to be conscripted. Soldiers brought their own weapons and horses, and expected to return home after the war. But as the Republic expanded, wars became longer and fronts moved far from Rome. The old system of warfare became unsustainable. Taking a spear and a sword and going off to fight for a year was no longer enough. Wars had become prolonged, and this created the need for professional soldiers. At that point, Rome began to centralize military financing. The state started paying its soldiers a wage called stipendium. This pay was not very high, but it was enough to ensure loyalty. Then came the real turning point. Conquest itself became a revenue model. Every new territory meant new taxes, new slaves, new gold mines, and new tribute. In other words, a new source of income. This was a self-sustaining cycle. War was financing more war. But the most interesting and dangerous part was this. Rome did not rely solely on taxes. It relied heavily on borrowing. Especially during long and costly wars like the Punic Wars against Carthage, the Republic took large public loans from wealthy Roman families, particularly from the rising financial class known as the equites. These were not patriotic donations, they were investments, and these investors expected returns, interest payments, tax collection privileges, and commercial advantages in newly conquered territories. Thus war became an investment, and the more profitable it was, the more wars Rome initiated. Does that sound familiar? Over time, this militarized economy reshaped everything. Political power began to fall into the hands of ambitious generals who promised plunder. Senators became part of this system. Private contractors known as publicani managed everything from logistics to tax collection and accumulated vast wealth in the process. This was military-industrial capitalism in a toga. But the costs kept rising. To pay soldiers and creditors, the state constantly needed new revenue. When conquests slowed or rebellions drained the treasury, Rome resorted to the oldest trick, debasing the currency. Starting in the reign of Emperor Nero, the silver content of the denarius was gradually reduced. Over the next 2 centuries, this process continued. What had once been a trusted currency slowly turned into something of uncertain value. Inflation rose. Trust eroded. By the 3rd century, Rome's monetary system was essentially collapsing. Meanwhile, the rich became even richer. Senators and equites preserved their wealth in land, slaves, and foreign assets. The poor, however, were forced to pay taxes with devalued money. While elites protected themselves through exemptions and privileges, public services collapsed. Corruption increased, poverty deepened, and the burden of endless wars fell most heavily on the lower classes, through inflation, forced labor, and conscription. This was not just a military collapse. It was a financial collapse. Now sit back and look at today. Governments running massive budget deficits. Wars financed by debt. Central banks quietly devaluing currency to cover those deficits. An upper class profiting from defense contracts and crises. Keeping the system running seems to require expansion. It's not a perfect parallel, but the resemblance is unsettling. What Rome teaches us is this. An economy based on expansion, especially through war, eventually hits a limit. There are no more lands to conquer, no more resources to exploit, and the system begins to turn inward. Debt remains, expectations remain, but revenue declines. That is when the state shifts the burden onto its own people. Rome turned to heavier taxation, more currency debasement, greater control. It used bread and circuses to keep the population calm. While elites secured themselves, the system began to break down at the bottom. Sound familiar? Today, we don't call it tribute. We call it taxation. We call it quantitative easing. We call it monetary policy. But the underlying logic is strikingly similar. Central banks create money. Governments spend more than they earn. The wealthy buy assets. The poor try to survive on declining purchasing power. Wars are still financed with debt. For example, the United States has spent trillions of dollars on the war in Iraq, much of it financed through borrowing. So, who profits? Who earns the interest? And ultimately, who pays the bill? You already know the answer. As in Rome, the cycle feeds itself. Once debt becomes the foundation of the system, you no longer need a crisis to print money. You just need to avoid collapse. And the longer it continues, the easier it becomes to believe everything is fine, until it isn't. That is why economic history matters. These are not just stories from the past. They are warning signs. When we look at Rome, we see a system where private finance gained too much power, became dependent on expansion, hollowed out its currency, and ultimately placed unsustainable burdens on its own people. Not because it was evil, but because it had no off switch. Today, we live in a different kind of empire. Digital, global, driven by capital flows instead of legions. But the underlying game is the same. Money and power move together. War is still profitable. Inflation still punishes the weak. And financial illusions work until they don't. So what can you do? Start by seeing the bigger picture, because most people don't. They think inflation is random. They see taxes as inevitable. They mistake debt for freedom. They believe growth can continue forever. The Stoics had a word for this: illusion. You can't completely exit the system, but you can understand it. And once you see it, you can act more consciously. Don't just try to understand money, understand the system. Don't just follow markets. Watch for systemic stress signals. And ask this question: who benefits when I don't understand? Because you are not meant to ask that question. You are not meant to question how Rome financed its wars, or how modern systems operate. Your attention is meant to be directed elsewhere, to headlines, debates, distractions, not to mechanisms, not to incentives, but now you know. And once you see it, it becomes hard to ignore. Financial awareness is not just budgeting or investing, it is understanding power, understanding systems, and seeing what lies behind the illusion of stability. So the next time you hear about a new crisis, a stimulus package, or a war, don't just watch. Follow the money. Ask who is lending. Ask who is profiting. And ask who ultimately pays the price. Because if history teaches us anything, it is this: empires do not fall when enemies break down the gates. They fall when the math stops working, when the money runs out, and when no one dares to fix it.